Good afternoon, everyone. Welcome to the Brown Bag. My name is Michelle Tausig. We have Lee Green on the line from IRI as well. Today we will talk about effective portfolio management, success factors, and failure modes with Rich Sonnenblick from Enrich Consulting. Before we get started, I'd just like to go over a few things. Everyone will be on mute. If you have a question, please raise your hand. We will unmute you. You can type your questions into the question box as well. And there will be natural breaks in the presentation when Rich will stop and take questions. So welcome, Rich. Let me tell you a little bit about Rich. Richard Sonnenblick is the founder and CEO of Enrich Consulting, a provider of enterprise portfolio management software for R&D opportunity and O&M activity prioritization. Enrich has implemented portfolio management solutions to Fortune 500 firms for over a decade and has learned much about the keys to the successful deployment of a forecasting and portfolio management process. Rich has worked to improve the effectiveness of multi-billion-dollar R&D portfolios for some of the largest pharmaceutical, high technology, and electricity generation firms in the world. Rich has a PhD in engineering and public policy from Carnegie Mellon University and a BA in physics from the University of California at Santa Cruz. Enrich Consulting is IRI's 2012 Platinum sponsor this year, and the effective portfolio management talk, which you are going to hear now, is repackaged from the annual meeting in May from last year. So welcome, Rich.
Thank you so much, Michelle. I really appreciate the opportunity to be part of this Brown Bag. And thank all of you for attending and for your time. I hope you'll find this an interesting conversation, and I do hope it's interactive. We have an opportunity at several points during the hour to stop and talk. So these are a set of select customers from Enrich. These companies all have two things in common. They are R&D driven companies. They're making extensive investments in research and development to push the frontiers of science or technology, or for the sake of their shareholders or for the sake of their customers. And second, they're making these investments in an environment of uncertainty. And that's really what we've spent the last decade and change trying to do, help companies manage the uncertainty that exists in any productive research and development process. For today's discussion, I wanted to talk about what works, what doesn't, and why in the realms of project forecasting, portfolio management, and project selection for investment. So I wanted to get the conversation started with a few examples from our experience in industry of the challenges, and hopefully some of these will resonate with you as well. The first is the projects are never canceled, either because there are gates in the development process that lack teeth, because there are no other more compelling projects available, or because there's weak governance, allowing turf battles to rule the investment decision making, rather than making a fact-driven process. Second, there's no link in some cases between portfolio and strategy, which occurs when the strategy is either not clearly described or it's not translated into actionable statements. We call that an incomplete strategy. And in these cases, the portfolio might contain projects that have little to do with the strategic goals of the company, and there's no way to really measure whether the set of projects in the portfolio are good enough, because there's no strategy that represents a litmus test or a screen. Finally, there's no balance in some firms between long and short-term goals. When companies are risk-averse, it's common to select safer project and product line extensions instead of forays into new markets or new technologies. But the result is a portfolio that requires significant resources because there are always opportunities for line extensions or maintenance projects, but it doesn't pave the way for the desired growth, especially if you're looking in a 5 or a longer term time horizon. So I want you to think back to Alice in Wonderland and ask yourselves, what did Alice ask the Cheshire Cat? If you can remember, she asked, "Would you tell me, please, which way I ought to go from here?" And the cat replied, "That depends a good deal on where you want to get to." Alice said, "Oh, I don't care much where." And so the cat replied, "Then it doesn't matter which way you go." So what's the parallel here? What's the connection? Well, our experience tells us that asking the right question sets you on the path to effective portfolio management. So deploying a process or a tool is not going to tell you where you want to go. You need to start with the question of where you want to go, what you want to be when you grow up. Answer that, and that's going to determine what the appropriate process is and how to employ a tool to help you measure your progress. So there are 3 tenets to effective portfolio management, and I put them on this screen as 3 kids. The one in the front is actually my daughter. The first tenet to effective portfolio management is value, and this is the one everyone thinks about probably most, sometimes to the detriment of the other 2. And so I put it front and center because it's visible and most prominent in people's thoughts. So value is important, but often unduly emphasized, and it's not sufficient. The next tenet is strategic alignment, which is also fairly visible. And strategic alignment defines the desired proportions for spending and the expected results, as I just talked about. For example, what technology platform will be most important to sales in 5 years, or what proportion of our revenue will be from new products in 2 years. The less thought about aspect of portfolio management is balance and risk, hiding there in the background. Put simply, we're saying don't put all your eggs in one basket. And by definition, a portfolio itself is a hedge. So what are the attributes that make your portfolio diverse, and how do you measure risk in your portfolio? And how much risk can you and your investors accept? So it's most important to have a clearly defined strategy, to know what question you're asking. Without that strategy, you don't know where you're trying to get to and how to judge the effectiveness or goodness or attractiveness of the set of projects in front of you. The ultimate criteria for portfolio fitness and attractiveness is completely unknown at that point. So you don't know which way to go from here if you can't say, like Alice, where you want to get to. So I'm going to go through 3 case studies. This is the first of those 3. This is a merger of titans. So there were 2 large vertically integrated firms looking to maximize efficiencies, and each one in and of themselves had a multi-billion-dollar research budget. But in order to exploit cost efficiencies and economies of scale, they proposed the merger. So in fact, up front, there were $2.5 billion of cost savings that had already been earmarked. So both companies were understaffed slightly for their respective pipelines pre-merger, but post-merger, retirements, packages, and layoffs exacerbated that situation, became even worse. So there was this desire, despite all of this, in terms of staffing challenges, to keep the entire pipeline intact so that no one was disenfranchised, no one felt like a second-class citizen, and most importantly, to them, no value was lost. So you might call it no project left behind. So their question was, how can we afford our pipeline without canceling anything? So in order to maintain the entire pipeline, they gave staffing priority just to the critical path activities in each program. And as the critical path moved on for each program, they shifted to the task at hand. And they found that they could do this, at least initially. But after 2 years, the pipeline told a different story. Attempting to continue on all projects resulted in extensive project delays, and there were execution issues that resulted in many project failures, including several costly late-stage failures just before launch. So if you've been in an organization that's starved for resources like this, you know about this kind of project gridlock. There are 2 key tenets of it. The first is that there are huge transaction costs for those key employees that are forced to bounce inefficiently from project to project as needed. And second, those key staff and resources become a bottleneck for entire project teams that queue up behind them waiting for their opportunity to get some attention. Now, despite this, we've seen utilization targets for FTEs in project management and capacity management exercises set at 130 or 150% of full-time, even though studies suggest that true time on task, as a percentage of the business day, is generally just between 50 and 75%. So clearly in this case study, their hearts were in the right place, but portfolio management is about making tough choices. So with this failure, they've invoked the disappointment of the finest captain of the Starship Enterprise, Jean-Luc Picard. So portfolio management is about saying no. And if you're not saying no, to quote one famous CEO, you aren't managing anything. There are 3 tools that you can use to say no effectively. The first is hard criteria. These might be minimum performance standards for NPV or an aggregate score of some sort. They may be minimum business case quality and completeness standards, that the business case has to have several pieces associated with it, and they have to be up to snuff and pass a test of the peers of the organization. And there may need to be expert and outsourced staff at the ready in order to perform certain key tasks for that project. And without any of this, the project categorically cannot go forward. Soft criteria is a little different. In the context of the portfolio, does this project rise above the fray? Now, scoring models or quantitative analysis can be used to highlight the lowest and highest potential opportunities, and then you can separate the wheat from the chaff based on your budget and strategy. And then third, and this is the most important because without this, nothing really works effectively, governance. So canceling a project needs to mean categorically that it's decommissioned. It doesn't rear up under another name or another budget, or it doesn't piggyback on another project. And then the people that were involved with this project need to be assigned to another project immediately following the decommissioning. Not reassigning those people always leaves the door open for zombie projects that get canceled and somehow they find their way into the next portfolio review, or people simply continue working on them. So the final chapter hasn't been written on this story yet. In the years since the merger, there's been additional outsourcing and R&D closures to reduce operating expenses, but the productivity of the merged organization hasn't yet approached either firm pre-merger. So rather than asking how can we afford our pipeline without canceling anything, it might have been more appropriate for them to ask how do we focus limited resources on our key strengths, and which assets should we sell off to those more qualified to develop them. So I wanted to take a moment here and see if there were any questions. Or comments as well. If you have a story similar to this that you'd like to relate, that would be great.
Okay, I'm not seeing any hands raised at the moment.
Okay, thank you. All right, let's go on to a second case study. This is a mid-sized drug company. Now, it was a traditionally conservative organization with single-digit growth for almost 20 years, and then they experienced much faster growth with the introduction of a blockbuster project launch. So you can see here for the first half of this 18-year time horizon, relatively tepid growth, and then an elbow occurring about halfway through this time horizon. Subsequent to that, they spent years heads down, just executing and managing the operations, getting them up to snuff for the scale that this blockbuster required. And as they get on top of the blockbuster, they want to use portfolio management to pick the winners from their portfolio of prospects. That's where we were engaged with this company. So by asking how do we pick the winners, they revealed their bias towards making decisions project by project. They weren't looking at the portfolio in total. We worked with them to assess mid and long-term cash flow in the portfolio, and we helped them forecast the base business through 2020. And management saw that they were heading for a leveling off of revenue 5 years from now, once we took into account attrition and uncertainty. So then they told us, well, we have line extensions. We can add those line extensions in, and we're going to get much better growth. So we took a hard look at those line extensions. We also looked at the probable attrition and uncertainty in market share, given those line extensions and what we knew about them. And still growth was stalling. They realized their culture of avoiding risky opportunities that had served them well over the past 2 decades was not going to be sufficient to meet these new expectations, essentially the new normal for the firm post-blockbuster. So the question was no longer how do we pick the winners. since the winners were not in this portfolio with the base business and the line extensions. The question became, what additional R&D activity is required to keep that level of growth steady state, or even better, improve growth over time? So once they understood how much growth was still required, they took a hard look at the goals and asked what it would take to attain them. They found, with an analysis of new products historically, in terms of the productivity of new products and the size of the revenues that new products could get them, that with enough early stage research and enough acquisition activity, they could probably bridge the gap. This final purple piece here puts that last piece of the puzzle in place. So this enabled them to go on an acquisition spree over 2 years and to staff early stage research and mid-stage development in a way that was unparalleled or unprecedented in the company, essentially doubling R&D expenditures. And this kind of analysis gave them the ammunition that R&D needed to request these additional funds. So the question they asked went from how do we pick the winners to how do we broaden the portfolio and maintain growth. And we had to paint a very deliberate and very clear picture of, given the risk and uncertainty in R&D and what they had historically been able to attain, how much R&D would be required in order to meet the new normal for the company and satisfy the street. But without that, R&D never would have been able to persuade management to change their posture from such a conservative posture to such an aggressive posture. Let me stop here again and see if there are any comments or questions from the Brownbag crowd.
Giving everybody a little time to unmute and talk among themselves and come up with a question. No, Rich, no hands raised at the moment.
Okay, thank you.
Mm-hmm.
Okay, let's go on to the next case study then. So this next example is a large life sciences firm, and the company had a culture that was profit and loss statement driven, from operations all the way down into R&D. So it pervaded the entire organization, and it had the effect of shifting the focus away from asking the right question. So the question we were presented with was very simply, are the NPVs right? Here is one mistake they made early on that they related to us when we came on board. They provided their management with a summary table like this across all of the projects prospectively that existed within the portfolio. So it was very exhaustive. It was also exhausting. And the detail didn't lead the executives to a winning portfolio. It led them down into the weeds of each specific project. And you can look at this and see one of the projects might have had a negative NPV, like Vrexagen, about 2/3 of the way down. And you can imagine that an hour later, after everyone had understood why that was the case, they came up for air and realized that, in fact, they had no more progress towards an actual portfolio than they had at the beginning of the hour. So those kinds of conversations are important to have, but before the portfolio reviews. And they were, by showing this to their portfolio team and decision-making team, having these very detailed project-level conversations to the detriment of the important portfolio conversations.
Rich, I have a question. Where in the process did these companies realize they were focused on the wrong question?
That's a great question. And many times it occurs in retrospect after a portfolio review when they see that they haven't set the appropriate frame, and so the answer that they received was unsatisfying, and there's a need to refocus for the next portfolio review. So for some of these companies, it was a multi-year process in coming up with the right questions. For some of these companies, we were brought onto the scene at a time where we could help refocus them to see that the question they were asking was, in most cases, too narrow, and that they needed to broaden out the horizons that they were considering, either in terms of what the strategic goals were and how they were going to meet them, or what the set of options on the table was for the firm moving forward. So we move them forward beyond this analysis. We also move them forward beyond a simple prioritization. So another tale they related to us was going through 2 years of reviews using a prioritization like the one you see here, what's entitled here a productivity ranking. So as is common in portfolio management, they had been ranking their projects on a ratio of NPV to current year budget. So they've been looking at these projects in descending order of that ratio, bang for the buck, and then plotting them on this graph cumulatively. So the highest ratio projects are here in the bottom left, and the lowest are up here in the top right. And the curve begins to flatten out because these projects, as you cumulatively add them to this plot, add less and less NPV for the amount of budget that they require. So the tradition in this kind of analysis is to take the projects that are most productive on the left and fund them to the exclusion of those on the right, using a line that is around the point where your budget level, your desired budget level exists. The problem with this analysis the first time they did it was that they focused on current year budget, as you can see down here in the bottom. They did that, it made sense to them, because the denominator was the same as where they were drawing the line relative to this year's funding. They weren't thinking about subsequent years, they were thinking about the current year. Now, the problem is that in thinking about the current year, this was favoring projects with less spend in that year, and it was also favoring projects that started later in the year because they had inherently lower cost in the coming year. So with the combination of these two, this again leads to the disappointment of Jean-Luc Picard. The next year they focused on total cost, or rather cost to launch in the x-axis for cost. But they found that they were excluding, for example, their oncology drugs because they were all less productive and a little bit riskier than their other projects. And they also found that they were excluding a large percentage of their early stage projects because those early stage projects in the simple global prioritization also fell below that line. So in realizing the prioritization was falling short and not helping them assess balance or real assessment of strategy and strategic alignment, they also felt that the NPV itself wasn't fully capturing a project's value. They wanted to understand when it was launching and how risky it was, and they decided finally to try to include all of these relevant factors into the synthesis. So they took a step back and asked to consider their positioning by division for each of the therapeutic areas that they were working in. Within each division, they wanted to pick from several possible strategies: dominate, compete, follow, and exit. And after intensive discussions, they selected 4 strategies to explore further from actually several dozen that seemed plausible at the beginning. So rather than thinking immediately about prioritization, they stopped and asked, what are we trying to do from a strategic standpoint? The 4 strategies were a simple prioritization so they could see what their old method would have accomplished for them, as sort of a base case. The second was a short-term focus that maximized revenues in the next 5 years, because in pharmaceutical development, 5 years is actually short-term. And then there were 2 leadership scenarios where they built a leadership in 2 different franchises, respectively. In the first case, they looked at immunology, and the second, oncology. So portfolio management is about bubble plots, right? So they decided to take each of these 4 scenarios and look at the projects that they would fund to describe the most compelling way to meet each of those respective strategies. Now, bubble plots are useful for reference, and you can get a sense of whether you have a lot or few risky projects, or a lot or a few maintenance and bread and butter projects. But they do nothing to indicate which portfolio is really affordable, or which portfolio meets strategic goals, or is too risky or risky enough. So as you compare the 4 scenarios here, it's really difficult to discern anything of importance about these 4 provisional portfolios. So this earns a double facepalm from both Picard and Riker. So here's a different bubble plot. This is looking at each bubble as a portfolio rather than the individual projects being represented by bubbles. And the idea was to compare the portfolios on strategic objectives. And so right away we can tell several things here. We can see that these 2 projects are cheaper. They fall on the left of the x-axis. These 2 projects are more valuable. Their bubble size is larger. And these 2 projects are less risky as a function of the risk-adjusted net present value over the net present value given success. So this gets a little more useful. We can begin to differentiate which of these 4 portfolios might be sufficiently affordable and valuable for the company as a whole. And then there were several trade-offs that needed to be looked at. At one point, they were looking at the dominate oncology and dominate immunology portfolios, and they wanted to trade off to understand exactly what the difference was between the 2 portfolios. So this pipeline analysis helped them see which projects were common to both portfolios. Those are the projects in gray here. And which projects were exclusive to oncology in pink or magenta, and which projects were exclusive to the immunology portfolio here in blue. So the executives here understood exactly what they were trading off in these 2 portfolios, and it was possible then to build, if they wanted, a hybrid portfolio that had a little bit of the benefits of both of these portfolios, or to simply understand that the differentiation between the 2 portfolios came down to essentially less than a handful of projects. This pipeline analysis also demonstrates something else. If you look at the dermatology division, which is the 2nd row, you see there's only 2 projects here. You might question why they're still playing in that area when there's so little activity project-wise. So executives, as we talked about, also cared about both short and long-term revenue. So for each of the portfolios, they began to look at the revenue as a whole. And in this case, we're looking at the expected value, but they also did this using uncertainty to get a wedge or a fan for each of the portfolios and understand the upside and downside potential of each of them. But even here, looking at the portfolio revenue just as an expected value, they were able to compare these to the target, which is given with the yellow dotted line, and show that only the dominate immunology portfolio was giving the long-term revenues that were represented in the strategic goals for the company as a whole. So the same kind of treatment, looking at the outcome of each portfolio in terms of revenue, is appropriate for other strategic or constraint dimensions as well. So looking at costs over time, FTEs for specific staff classes over time, product launches by year, or looking at year-on-year growth. Whichever of these are in alignment with strategy, begin to look at what the portfolio as a whole can contribute to progress for each of those strategic goals and trade off multiple portfolios. So this is really a paradigm shift for a lot of organizations we work with. Rather than thinking about the individual projects, thinking about what types of strategies would yield a portfolio that would be in alignment with those strategies, and then building provisional portfolios that show you whether those strategies can actually be attained given the projects that exist in your provisional portfolio set today. So this company went from a question of are the NPVs right to does our portfolio provide balanced growth? And in the end, there were a number of objectives to trade off, and those objective trade-offs boil down to a relatively small group of projects. So from analyses like those in the previous slides, each executive could pick their preferred portfolio and with this set of visualizations understand which projects would be included and which would have to be sacrificed in order to get that progress towards the strategic goals. So over a period of about two and a half weeks, there was intense discussion, which is a good thing, and there were additional analyses with additional hybrid portfolios that were requested. And eventually they came to a decision that blended their initial preferences with the results of what they learned during the process. So the discussion was constantly focused on portfolios and strategic goals and comparison or alignment between them because of the way the team presented the data to decision makers and how the trade-offs were made completely transparent. So it became a matter of what objectives should we focus on rather than which projects are our favorites.
Rich, I have another question. This is from Jack Stevenson of Chevron. You mentioned paradigm shifts. What good practices, lessons learned do you have to accomplish this?
That's a good one, Jack. I think the key here is understanding portfolio management is about catalyzing change in the organization. And the way to catalyze change is to make people uncomfortable with the status quo. And the way to do that is to paint a very clear picture of where the status quo is heading the organization or is preparing the organization to be in 5 years' time, in 10 years' time, whatever the appropriate time horizon is for the organization. So there needs to be that assessment of, based on everything we are doing today, here is where we will be in 2 years. So far, so good. It looks like we're still making our targets. But 5 years down the line or 10 years down the line, at some point, the line extensions we're focusing on and the small bets that we seem so intent on funding to the detriment of hard to make, seemingly too risky big bets is going to cost us revenue and market share. And I think organizations who are able to make that case for the discomfort associated with the present situation and the status quo can then open the door to a discussion of making some of the more difficult, making some of the riskier bets because the alternative now seems a lot less attractive.
And Rich, I have another question from June Goodman. June, I'm going to unmute you. You should be able to ask your question now.
Can you hear me?
June?
Can you hear me?
Okay, I'm not hearing anything. Can you see in your question in the question box for me? Oh, there you go.
Can you hear me?
Yes,
Very
we can.
faintly. Are you on speakerphone?
I'm on my computer phone, so
Okay.
Jack, is that better?
A little bit better, yes.
Okay, yeah. My question was, in all the examples you've shown so far, you seem to be always having a net present value. And in our experience, NPV is very, very difficult to calculate for very early stage R&D when you may be working on a molecule and you don't know whether that molecule is going to go into a refinery as a catalyst or into a chemical plant. You may not know NPV, and at best your calculations of NPV are wildly inaccurate for early stage projects. So could you comment on that?
Rich, were you able to hear any of that?
Yes, yeah, I think so, and tell me if the answer is on the mark here. I completely agree with you that for many organizations, even those with late-stage R&D in their purview, net present value may not be the right metric. There are challenges with qualitative metrics. We've seen that in some cases qualitative metrics are hard to differentiate, make it hard to differentiate projects. If a series of questions are assessed on a scale from 1 to 10, it always seems like across the set of questions, every project ends up with 6.5 to 7.5, and it's difficult to differentiate. And we've helped many organizations whittle down their questions, because one of the most egregious problems we've seen is asking too many questions so that every project has the ability to have a few questions where they're getting 10s, and every project has a few they get dinged for, and that is a regression to the mean. And second, we've seen that there's a real need with those few questions that are asked, so we would recommend no more than 8 questions are asked in total, that there are very clear anchors so that everyone understands the difference between a 1 and a 5 or a 2 and an 8 on this 1 to 10 or 1 to 5 base scale. And so it's unambiguous and completely defensible to say this project rates an 8 on this scale of unmet need, or this project rates a 2 on this scale of availability in people and skills, because there's an anchor to each of the numbers in that scale that make it very clear what that number means. I do feel qualitative assessment mechanisms have a place. I think that there needs to be a very clear mechanism for assessing the veracity or the integrity of the numbers that have been assessed, both in qualitative and quantitative assessment, and that's done either in a town hall style conversation with peers within the R&D organization or with management reviews in some way, so that everyone understands that there's a level playing field for the assessments, and that the motivational biases that always exist in organizations are minimized.
Okay, thanks. I have another question from Nate Miranda of PepsiCo. In the risk versus development cost chart, why do you call the right-hand side group valuable?
The risk versus development cost chart. Is Nate unmuted? Can he help me find which one he was talking about? Was this in the Nate, was it here?
Slide 20, maybe?
Okay. Right. So why is the right-hand side valuable? Yeah, the idea here was that the size of the bubble was the NPV, and so these two are valuable because they have a higher NPV based on the size of the bubble compared to these two. So this is really a way to differentiate the portfolios at a very high level, in that you can tell that there is a difference in value and a difference in cost. The critical thing to remember is that this is an incomplete analysis as well, because it doesn't tell you if they are valuable enough. That is, do these meet your revenue targets, either on a division-by-division basis or for the company as a whole? And it doesn't tell you whether they are affordable. It doesn't tell you whether you have the resources within your organization to actually fund them to good effect. And to go to that next step is to go through these kind of analyses here of looking at where is our revenue target, where is each of these portfolios coming down in terms of the ability to meet that revenue target, both accounting for risk and assuming at the rosiest that everything actually gets to market and does what we want, and being able to bridge the gap between those two and understand where does the target fall vis-a-vis that bracket between the risk-adjusted and the unadjusted assessments.
Nate says thanks.
Okay. Very good. Thank you, Nate. I appreciate the question. You know, I wanted to, let me make sure there are no more questions here, and then I wanted to just bring up one more point for thought and potential discussion. I'll give us 15 seconds here if anyone has a question about these 3 case studies that we've already been through, or something more generally they wanted to ask about or talk about.
Yes, I have another question from June Goodman. In your examples, all the portfolios are relatively similar. Example, all drugs. So development costs are likely to be fairly similar and outcomes fairly easy to predict. What comments do you have for very heterogeneous portfolios?
Well, it's interesting you point that out. We find that in most companies, the homogeneity of portfolios is actually a liability rather than an asset. And that goes back to the point I made earlier about not thinking about all of the options that you have. And this is often occurring because companies have so little of their R&D budget that they feel is discretionary, that the vast majority of their R&D budgets are locked into projects, and so there may only be 30 or 20% that they feel they have wiggle room for, and as a result, the number of portfolio options or levers they have is somewhat constrained. Thinking about the other extreme, where you have a heterogeneity of portfolios, presents a different but related set of problems. You need to think about your strategic goals perhaps in a discretized way, to bucket them a little bit more carefully, and think on a divisional basis or on a technology platform basis. Which platforms do you want to lead in? Which platforms do you want to play in? And which platforms can you not afford to devote resources to and probably need to deaccession within the firm? We find companies with very heterogeneous or diverse product mixes are often dealing with the problem of not being able to say no often enough, and they find themselves with a lack of focus and also spreading resources too thin across the diverse portfolio. Did I answer that, or was there another aspect of that that you wanted to probe?
I'll just wait for a second and see if another question or comment comes in.
Sure.
Nope, I think we're good.
Okay, great. So I know
wait
that.
A minute. Hold on.
Sure.
The aspect, so you have 100 million portfolio and 1 million portfolio. How do you portray these? What?
So was that the complete question, Michelle?
Yeah. So I'm not understanding that, but.
You know, I think that in many cases, what we help a company do and what we recommend a company do is to play out the scenario of what would happen over time with each of these prospective portfolios. And to do that with an eyes wide open accounting of the risk, and that risk may be technology feasibility risk, or it may be market risk, or it may be regulatory hurdles, or a combination of all of these, and to understand what the prospects for each of these portfolios might be moving forward. Now, in the context of, is it worthwhile to spend money on this $1 million activity versus this $100 million activity, we see most companies making the mistake of too many $1 million activities and not enough $100 million activities. If that's the relative scale that your company is playing on, you could divide those numbers by 10 or 5 if that's more appropriate for your company's size. And we find that it's important to think about the strategic goals of how much growth are you looking for and how did you get to the size you are today? What big bets were made 2 years ago or 5 years ago or 10 or even 20 years ago that enabled you to grow to the level you are today? Because that can be another way to jar the company out of the complacency and the risk-avoiding mindset that is so common in a larger company. It's hard to take those risks when you have a lot to lose. People forget that they probably risked a lot once upon a time to get to the level of success that currently exists, and they may need to risk again to get to the next level of success and size. I wanted to conclude with one more, not so much a case study, but a set of observations. Many times our portfolio discussions with companies end at a point of, well, that's great that we now see that we don't have the opportunities on the table that we need to meet our growth goals. But how in the world can we bring those opportunities inside, and how in the world can we then capitalize on them to take the big bets we want to take? And one thing I like to do with companies, just as a thought experiment, is to compare the way a venture capitalist works with a series of startups with the way internal R&D management works with the research and development teams under that person's purview. So it's a picture of Vinod Khosla here of Khosla Ventures. It's a successful entrepreneur and venture capitalist. So if you think about comparing in the first column here a Fortune 500 driven R&D organization, and in the second column a venture capital stroke startup model, the first difference involves the number of projects under active management. Within a Fortune 500 company, you might have 100 to 200 ongoing initiatives, whereas within a venture capital organization, the half dozen to dozen partners are looking at maybe 20 to 100 projects total. So there's already a much greater teacher-student ratio, if you will, within the venture capital world relative to the Fortune 500 world. The next point is even more stark. The percent of maintenance projects, or core projects, if you want to use that vocabulary, we see within Fortune 500 companies is somewhere on the order of 40 to 90% of an R&D organization's budget. Whereas in the venture capital world, by definition, there are 0% maintenance projects. Everything that's being attempted here is disruptive or nearly disruptive. Otherwise, the VCs wouldn't be interested in it in the first place. Then think about how often the management, whether it's a venture capitalist on the board of a startup or the R&D management team, touches and influences and advises the R&D team or the startup, respectively. So in an R&D organization, you may have quarterly or semi-annual annual reviews, or these may be milestone-based as a function of when the next milestone is going to be reached. Whereas in the venture capital world, a VC will be talking to the CEO or the management team within a startup twice a month, sometimes twice a week, sometimes even more during a critical period. So again, there's much more of a hands-on approach, and the idea that those VCs are adding quite a bit of value and experience to the management organization or to the management team within the startup compared to what's happening within most R&D teams. Documentation is another interesting contrast. When you think about a R&D team, you think about a business plan, and that business plan looks something like this. It might be 15 pages, it might be 60 pages, and it goes through a lot of detail about the go-to-market strategy and the manufacturing and the segmentation and all of this. And you compare that with a business model. This is an example of a business model canvas created by Alexander Osterwalder as a one-page complete summary, complete synopsis of what's going on as this provisional business matures. And it has critical components of the business plan on it, but it's all summarized down to the key points so that a venture capitalist or a startup management team can look at this all at once as a poster on the wall or projected onto a wall. And you can get a sense of everything from the value propositions to the customer relationships that are critical, to the segments, to the channels that get you to those segments, and the revenue streams and the revenue model that's going to be obtained. On the left side, you have the costs, the partners, the key activities, and the key resources, so all of the enabling pieces. And then the glue here, as I mentioned earlier, are the value propositions. So the idea of putting it all on one page is that you can immediately see if it holds together holistically, you can immediately see if there are any missing components, and you can easily update it when you see that something needs to be revised and the goalposts are shifting. Not so much with a business plan. Now, there's no question that this business model canvas is not going to satisfy the organization as it scales, but during the critical period of customer development and product prototyping, this is a much more agile way to assess the completeness of the business opportunity. So criteria for additional funding is the next row here. And for a Fortune 500 company, there may be a focus, as we talked about earlier, on quantitative metrics such as NPV or ENPV. And what's interesting in the venture capital world is there might be a one-sheet spreadsheet that has a validated business model on it, but it gets no more complicated than that because they're interested in the size of the market, whether the market represents a true unmet need and a green field in terms of the competitive landscape, and whether there are barriers of entry so that other companies could not come in as quickly once this company had established itself, and whether there's a willingness to pay on the part of the customers. And that's it, keeping it simple. So when you look at team and customer interactions, this is another important point during this early phase of development, moving things into an R&D organization. Within R&D, we hear about customer interactions such as focus groups every 2 to 6 months. Whereas in the startup world, the current best practice is that those interactions with customers or prospects are continuous, at least every 2 weeks, maybe every week. And that goes on not just for 3 weeks and then stops for 6 months and then starts again, but it's continuous over the first 2 years of a startup's lifetime. So those touch points are much more frequent as well. And so we're seeing a theme here, the touch points of the management within the R&D organization versus the VCs working with startups. It's much more frequent for VCs, and it's much more frequent for the startups themselves to be talking with potential customers much more frequently than what we see in most organizations. And there are exceptions, obviously, like Procter & Gamble is one that prides itself on the degree of customer engagement and understanding the customer from an anthropological viewpoint rather than simply a consumer viewpoint. When we think about potential for failure and how agile the organization is, usually the failure of projects within a large R&D organization occur or can occur at the milestones. But between the milestones, failure isn't something that's discussed, not openly in any case. Within a venture capital model, the potential for failure exists at every customer interaction, and those are occurring, as we talked about, very frequently. The difference is that what failure means is interpreted differently. So within an R&D organization, the likely response to failure, once it is actually laid bare, is to either abandon the project or plead forgiveness in some way, whereas within the venture capital world, the standard is, of course you're going to fail and you're going to pivot as a result of those failures, because those failures are really nothing more than learning events, showing you that part of that business model canvas was not what you thought. And so you have this constant process of making hypotheses based on the business model canvas for the customer need, the value proposition, and so forth. And when you're working with your customers and you see that some of those hypotheses are invalid, you go back and you redesign that aspect of the business model to move forward in a different way, and now you validate those hypotheses that have subsequently come to the fore. So that process of creating a hypothesis, what will the customer think, what will they do, what will they want, validating it, and then if necessary pivoting is a critical feature of today's VC and startup model. So it's not to say that one is right and one is wrong here, but rather there's an opportunity to learn from how different these two models work today in the prototypical sense and see if we can pull some of the best features of the VC startup world into the Fortune 500, into the larger R&D organizations that we work with on a daily basis at Enrich. Well, we're coming up to the top of the hour, and for those of you that might have questions or comments on this, I'd love to hear them at this time.
We have a question from June Goodman. June, do you want me to try to unmute you this time? This is a pretty lengthy question here. I'm going to try. Okay, June. Let's see if we can hear you.
Okay, can you hear me? Can you hear me?
That's a little bit
better. Do you hear me?
Yeah.
Yes.
Okay, so I'm still on the heterogeneity topic. So a company like ours, we've actually got way more than 200 projects, and a company like Boeing that's an order of magnitude bigger than us in terms of R&D has thousands and thousands of projects, and they range from very small, and the examples I would say is seat belts on a plane or lab methods in our business, to very large offshore platforms for us, airplane wings for Boeing. And then there are dependencies such as you need a new paint, you need less paint on the wings to keep the weight down, but the paint is actually in a different portfolio because it covers the entire plane, not just the wing. So we've got the concept of heterogeneity and we've got the concept of dependencies. And I'm just interested in how, you started off by saying you don't show decision makers Excel workbooks, and I think that anybody that does that's asking for a lot of flack. But how do you advise demonstrating a very heterogeneous portfolio to decision makers?
Okay, thank you for explaining that in more detail. And I think that heterogeneity speaks to a point of looking at the strategy and thinking about strategic buckets, and thinking about what percentage of your projects within a division should be maintenance projects or safety-related projects or disruptive projects or extending product line projects, and then looking aspirationally at those percentages relative to what the current spend is. And so one way to think about that would be if you look at the grid I have on the screen right now, looking at what the current spending is in terms of percentages, and then asking yourselves how far away is this current spend from where you want to go aspirationally, and how do you bridge the gap between the two? So that current spend is not only a matter of looking at the current percentages, but also looking at the value of the projects within each of those buckets. And so here we're showing a simple 2x2 matrix. There may actually be a larger matrix for a much more heterogeneous company than just the 9 options we see here. But it's important to drill down and look at how many high-value projects are in each of these buckets, how many low-value, how many projects that are high-value but are as yet unfunded exist, and then use that information to rebalance the spending by understanding how far you are from your aspirational split that you think is going to get you to some long-term or medium-term strategic goals? And what are the realities of not being able to turn on a dime and suddenly create high-value projects in one of these buckets that is chronically underrepresented relative to those aspirations?
We have a couple last questions here, if you can take them, Rich. One from Green Tweed. What are the attributes of the right questions organizations should be asking?
So I think it begins with, where do you want to be in 5 years? What do people want to think about Green and Tweed in terms of where are you leading in the marketplace? Where are you playing in total in the marketplace? And then to ask, what does that mean for today's product portfolio? And where is the gap between where you're currently spending your money and where you would need to spend your money, both in terms of a balance between risky projects and less risky, more maintenance-oriented projects, and in terms of the different technology platforms you're either bolstering or creating de novo, and the divisions, more broadly speaking, that you're playing in and selling in. And once you've answered those questions, then you can take a look at where you're spending your money today and assess how you're going to get from here to that strategic set of aspirations. We find many times people are starting instead with that list of projects that I showed you earlier, thinking about, well, these are the projects we have. Do we really believe the NPVs that we forecast for these projects, or the qualitative assessment scores we've created for these projects? And it's premature to talk about that until you truly understand where you want to be and you think about what the portfolio needs to look like in order to enable you to get there. Then you can go back and think about the compelling combinations of projects that might help you get there, and whether anything that you have in your portfolio today is really sufficient to get there at all.
Well, Rich, we're past the hour now. I want to take this opportunity to thank you and to thank everyone for attending. And if any of you have any follow-up questions, Rich Sonnenblick will be at the Member Summit October 15th. And I know many of you are going to be attending as well, so we can continue this conversation at the Member Summit. And if you haven't registered already, please, there's still time. You can still join us in Indianapolis. Thanks again, Rich.
Thank you, everyone, for your time and great participation. I really appreciate it.
One more question. Yeah, these slides are available, and they are on the Brownbag page on the IRI website, and right now they are also on the home page under the Brownbag section. And the recording will be available shortly as well, and I'll post that. So thank you again.